banking crisis in Asia. Banks have assets. These assets are mostly loans that they extend to corporations as well as individuals. To finance these loans, banks have got liabilities. These liabilities include bonds, which they issue to the market, and also equity, which, as you know, is the balancing item. This equity in an Asian bank typically represents only 1/15 of the total of assets. So here's the trick. If you have so little equity, any hit on your assets, such as a non-performing loan, will directly impact your equity. For instance, if in your portfolio of loan you have a 3% rate of non-performing assets, what's going to happen is this will impact the valuation of your assets, and in mark-to-market in the international financial reporting standards, this will have an impact on equity as well. Now here's what happens. With the new set of so-called Basel III rules, banks need to have more equity in their liabilities to cover for potential non-performing assets or risky assets. So what do you do then? Either you increase your equity or you reduce the assets. But here's the trick. If you have the combination of adapting to those rules and generating non-performing loans in your portfolio, you will have a deterioration of your equity to asset ratio. Now there's two ways banks can go around this. Either they become a lot more attentive to their portfolio and they start refusing a lot of loans, or they float more bonds or more equity, which is a lot less likely because given the rules and given the fact that the return on equity of Asian banks is falling rapidly to 5 or 6%. The more likely outcome here is that banks will significantly curtail their lending. And here, a big space, a big competitive space opens up to new actors. Actors such as Fintech and actors such as SG Cash. Well-managed actors who are capable of having a good portfolio of assets with low non-performing loans will eventually supplant these banks.